Today, we're going to cover Chapter 11, and Chapter 11 describes the income statement, the statement of comprehensive income, and the statement of stockholders' equity. The first topic we want to talk about is the evaluation of the quality of earnings. A corporation's net income or net earnings, including earnings per share, receives more attention than any other single item in the financial statements. To stockholders, the larger the net income, the greater the likelihood of dividends. In addition, a steady and upward trend in persistent earnings generally translates sooner or later to a higher stock price. There are many components of earnings quality. The most prominent are proper revenue and expense recognition, high and improving gross margin to sales ratio, low operating expenses compared to sales, and high and improving operating earnings relative to sales. The first component of earnings quality and the top line of the income statement is the proper recognition of net revenue or net sales. Under accrual accounting, revenue should be recognized when it is earned. That is, when the selling business has fulfilled its obligation to either deliver the product or the service to the customer. In recognizing revenue, several important events usually have to occur. The seller delivers the product or service to the customer. The seller takes both possession and ownership of the product or service. The customer takes both ownership and possession of the product or service, and the seller either collects cash or is reasonably assured of collecting the cash in the near future. Cost of goods sold represents the direct cost of the goods sold to customers. In general, assuming cost of goods sold are accurately measured each period, steadily decreasing cost of goods sold as a percentage of net sales revenue is regarded as a sign of increasing earnings quality. Gross profit or gross margin represents the difference between net sales and cost of goods sold. Conversely, with steadily decreasing cost of goods sold, steadily increasing gross profit as a percentage of net sales is considered a sign of increased earnings quality. As implied in the title, operating expenses are the ongoing expenses incurred by the entity other than direct expenses for merchandise and other costs directly related to sales. The largest operating expenses generally include salaries, wages, utilities, and supplies. Again, given that the entity takes care to accurately measure operating expenses, the lower these costs are relative to sales, the more efficiently and therefore the more profitably we can assume management is operating the business. When companies are having revenue difficulties, it is wise to try to trim fat from operations by cutting back on costs. The trick, though, is knowing when and how much to cut, because indiscriminate cost cutting can erode perceived quality of the company's product or service, which further damages the bottom line. Our next topic is to discuss how we account for foreign currency gains and losses. Increasingly so, international transactions are common in many businesses and can significantly influence reported earnings. Manufacturing of all kinds of products have migrated to places such as China, India, and Southeast Asia, where labor and materials are less costly. Transportation and communication systems, as well as manufacturing processes, have improved to the point at which it has become convenient and cost-effective for retailers to purchase virtually all items for resale from companies in these developing countries. So let's assume a U.S. retailer ships products to Mexico. The sale can be made in dollars or in pesos. If the Mexican company agrees to pay in dollars, the U.S. retailer avoids the complication of dealing in a foreign currency, and the transaction is the same as selling at a store in the U.S. But suppose the Mexican company orders 1 million pesos, approximately $90,000 worth of inventory from a U.S. retailer. Further, suppose that the Mexican company requests to pay in pesos, and the U.S. retailer agrees to receive pesos instead of dollars. The U.S. retailer will need to convert the pesos to dollars, so the transaction poses a challenge. What if the peso weakens before the U.S. retailer collects from the Mexican chain? In that case, the U.S. retailer will not collect as many dollars as expected for resale from companies in these developing countries. The U.S. retailer sells goods to the Mexican chain for a price of 1 million pesos on July 28. On that date, a peso is worth 0.08 cents per dollar. 1 month later, on August 28, the peso has weakened against the dollar so that a peso is worth only 0.083 per dollar. The U.S. retailer receives 1 million pesos from the Mexican chain on August 28, but the dollar value of the U.S. retailer's cash receipt is $3,000 less than expected. The U.S. retailer ends up earning less than hoped for on the transaction. These journal entries show how the U.S. retailer would account for these transactions. And you can see that on the 1018 entry, we've incurred a foreign currency transaction loss of $3,000 as a result of the decline in value of the peso to the dollar. Purchasing in a foreign currency also exposes a company to foreign currency exchange risk. To illustrate, assume a U.S. retailer values a shipment of watches from a Swiss company. The price is 20,000 Swiss francs. On September 15th, the U.S. retailer receives the goods and the Swiss franc is quoted at $1.15. When the U.S. retailer pays 2 weeks later, the Swiss franc has weakened against the dollar to $1.10 per dollar, or $1.10 per Swiss franc. The U.S. retailer would record the purchase and repayment as shown here. And so in this case, we can see on 1018 that the U.S. retailer had experienced a foreign currency transaction gain. The foreign currency transaction gain account holds gains on transactions settled in a foreign currency. Likewise, the foreign currency transaction loss account holds losses on transactions conducted in foreign currency. Report the net amount of these two accounts on the income statement as other revenues and gains or other expenses and losses as the case may be. For example, assuming the two transactions we just described were the only two during the year, the U.S. retailer would combine its $3,000 foreign currency loss and the $1,000 gain and report the net loss of $2,000 on the income statement as shown here. Now let's talk some about accounting for other items on the income statement. And so interest income represents the return earned on invested money, and interest expense represents the cost of borrowed money. Corporations pay income tax as individuals do, but corporate and personal tax rates differ. The current federal tax rate on most corporate income is 35%. Most states also levy income taxes on corporations, so most corporations have a combined federal and income state tax rate of approximately 40% to account for the income tax the corporation measures. Income tax expense, an expense on the income statement. Income tax expense helps measure net income. The corporation also measures income tax payable, which is a current liability on the balance sheet, and income tax payable represents the amount of tax to be paid to the government. Income tax expense is based on the income on the company's financial statements, while income tax payable is based on the taxable income from the corporation's tax return. For most companies, tax expense and tax payable differ. Some revenues and expenses affect income differently for accounting and for tax purposes. The most common difference between accounting income and taxable income occurs when a corporation uses straight-line depreciation on its financial statements and accelerated depreciation for the tax return. You may recall we talked about this earlier in the plant asset chapter dealing with depreciation methods. Other differences result from particular items where cash is received or paid in different years than the revenue or expenses recognized under accrual accounting. And so let's use an example to help clarify this. Using exercise 11-19A, Martel Heights Company income statement reported income of $500,000 before tax. The company's income tax return filed with the IRS showed taxable income of $440,000. During 2012, Martel Heights was subject to an income tax rate of 40%. So first, let's journalize Martel Heights tax rates or income taxes for 2012. And then we want to answer how much income tax did Martel Heights have to pay for the year. So to journalize the taxes, income tax expense, we have to take the reported income of $500,000 before tax of $500,000 times their tax rate, or $200,000, which is a debit to income tax expense. Secondly, we record the income tax payable, which is based on the income tax return showing $440,000 of taxable income times 40%, or $176,000, and the difference between the $176,000 of income tax payable and the $200,000 of income tax expense is the deferred tax liability, which we credit then. Continuing with this exercise, at the beginning of 2012, Martel Heights' tax balance of deferred tax liability was $32,000. How much deferred tax liability did Martel Heights report on its balance sheet at December 31st, 2012? And here we see it's simply a matter of taking the opening balance of $32,000 plus the credit we posted during 2012 of $24,000, so that at the end of the year we'll show a deferred tax liability balance of $56,000. So how is income tax from continuing operations used in investment analysis? To estimate the value of a corporation's common stock, financial analysts determine the present value of its stream of future income. Analysts must use some interest rate to compute the present value. This rate is based on the risk that the company might not be able to earn sufficient annual income for the indefinite future. The rate is also called the investment capitalization rate because it is used to estimate the value of an investment. The higher the risk, the higher the rate, and vice versa. The current market value of a company can be determined by multiplying the number of common shares outstanding by the current market price per share. By comparing the estimated value to the current market value of a company, investors can make decisions on whether to buy, hold, sell the company's stock. Most large companies engage in several lines of business. We call each identifiable part of a company a segment of the business. A company may sell a segment of its business. The discontinuance of a business segment, either through sale or closure, is viewed as a one-time transaction. The gain or loss is reported net of the income tax benefit that the company receives from being allowed to deduct it on its corporate income tax return. Financial analysts typically do not include discontinued operations in predictions of future corporate income because the discontinued segments will not continue to generate income for the company, and any loss incurred by discontinuing the segment will not be repeated in the future. So companies sometimes change from one accounting method to another, such as from double declining balance depreciation method to straight line depreciation, or from first in, first out inventory costing to average cost for inventory. An accounting change makes it difficult to compare one period with preceding periods. Without detailed information, investors cannot compare, and they can be misled into thinking that the current year is better or worse than the preceding year, when in fact the only difference is a change in accounting method. Two types of accounting changes are most relevant to introductory accounting. Changes in accounting estimates, including changing the estimated life of a building or equipment and the collectability of receivables. For these types of changes, company reports them out for the current and future period on a new basis. There is no looking back to the past. A change in depreciation method is treated as a change in estimate. There are also changes in accounting principles, which include most changes in accounting methods, such as from FIFO to average cost for inventory, and one from another to revenue or expense. For these changes, the company reports figures for all periods presented in the income statement, past as well as current, on the new basis. The company retrospectively restates, that looks back and restates, all prior period amounts that are presented for comparative purposes with the current year, as though the new accounting method has been in effect all along. This lets investors compare all periods that are presented on the same accounting basis. If an accounting change impacts periods prior to the earliest one presented in the current income statement, an adjustment to retained earnings must be made. Our next objective is to compute earnings per share. final segment of the income statement reports earnings per share. Earnings per share, or EPS, is the amount of a company's net income per share of its outstanding common stock. EPS is a key measure of a business's success because it shows how much income the company earned for each share of stock. Stock prices are quoted at an amount per share, and investors buy a certain number of shares. EPS is used to help determine the value of a share of stock. A corporation lists its various sources of income separately. That is, continuing operations, discontinuing operations, and so on. It also lists its EPS figure for each element of net income. And so let's walk through an example using exercise 11-20A. We're told that Palace Loan Company's balance sheet reports the following. Preferred stock at $20 par value, 2%, 11,000 shares issued. Common stock at $2.50 par value, 1.1 million shares issued. And treasury stock, common, at 120,000 shares at cost. During 2012, Palace earned net income of $6.2 million. Compute Palace's earnings per share, or EPS, for 2012. Round EPS to 2 decimal places. To determine EPS, the preferred dividends computed on the previous slide are subtracted from the given net income. This is then divided by the outstanding shares to determine an EPS of $6.32. Occasionally, a company records a revenue or an expense incorrectly. If the error is corrected in a later period, the balance of retained earnings is wrong until corrected. Corrections to retained earnings for periods of an earlier period are also called prior period adjustments. The prior period adjustment appears on the statement of retained earnings. Prior period adjustments are not reported on the income statement because they relate to an earlier accounting period. Prior period adjustments would appear on the prior period adjustments would appear on the statement of retained earnings. And so next we want to talk about how to analyze the statement of comprehensive income and the statement of stockholders' equity. All companies must report net income or net loss on their income statements. Companies with unrealized gains and losses on certain investments and foreign currency translation adjustments also report another income figure. That is comprehensive net income, which is the company's change in total stockholders' equity from all sources other than from the owners of the business. Comprehensive income includes net income plus unrealized gains or losses on available for sale investments and foreign currency translation adjustments. These items do not enter into the determination of net income or the earnings per share. For accounting periods after November 15, 2011, comprehensive income for a company must be presented either alone in a separate statement of comprehensive income or combined with net income into a unified statement of comprehensive income rather than as a part of the statement of stockholders' equity. The statement of stockholders' equity reports the reasons for all the changes in the stockholders' equity section of the balance sheet during the period. The format for the statement includes a column for each element of equity, starting with common stock on the left. The top row reports beginning balances taken from last period's balance sheet. The rows then report the various transactions that affected equity, starting with net earnings. The statement ends with year-end balances. And so our last topic for this chapter is to differentiate management and auditors' responsibility in financial reporting. Management issues a report on internal control over financial reporting along with the company's financial statements. Management declares its responsibility for the internal controls over financial reporting in accordance with the Securities Exchange Act of 1934. Management also states that it's conducted an assessment of internal controls over financial reporting based on the framework established by the Committee of Sponsoring Organizations, or COSO, of the Treadway Commission, and has concluded that internal controls over financial reporting are effective. In addition, management states that the internal controls of the company have been audited by the company's outside auditors and refers to their report. The Securities Exchange Act of 1934 requires companies that issue their stock publicly to file audited financial statements with the SEC. Companies engage outside auditors who are certified public accountants to examine their financial statements as well as their internal controls over financial reporting. The independent auditors decide whether the company's financial statements comply with generally accepted accounting principles. They must also decide whether the internal controls of the company meet certain standards. They then issue a combined audit report on both the financial statements and the company's system of internal controls over financial reporting. The auditors are also allowed to issue separate financial reports or audit opinions, and if they issue separate audit opinions, one on internal controls over financial reporting and one on the financial statements, each of the other reports needs to be referenced in each of the corresponding reports. And so that is to say that the report on internal controls must reference the opinion on the financial statements report, and the financial statements report must reference the audit opinion on the internal controls over financial reporting. And so it's the auditor's discretion as to which method is used. The independent audit adds credibility to financial statements of a company as well as to its system of internal controls. I would encourage you, for those of you who are interested in accounting further, and particularly maybe interested in a career, to look at the Virginia International University's auditing course. That really covers a lot of the fundamental audit processes, methodologies, the terminology, and just what's important to an accountant as they conduct an internal audit and an external audit. And so this concludes Chapter 11. I encourage you, as always, to read the chapter closely and then go ahead and work through the learning exercises. I look forward to talking with you about Chapter 12. Thank you.